Hello, everyone, and welcome to another great webinar here on CPAacademy.org. My name is Chris, and I'll be your webinar host for today. Our topic today is Reduce Your Tax Burden with Qualified Opportunity Zone Investing. And our presenter today is Jeff Feinstein. Before getting started, folks, if you haven't already, go over to the Q&A and let me know you can hear my voice, see us on your screen, as well as see Jeff's very first slide. Also in the Q&A, we'd love to know where attendees are coming in for us today, and we'd love to know where city is that you're coming from. And I am seeing folks coming in from all over: Missouri, Texas, Tennessee, Canada, New Orleans again, California, more Texas, Puerto Rico. Fantastic. Welcome one and welcome all. Now, this Q&A can be used in a couple of ways. If you have any questions regarding content for Jeff, put them there, and if time does permit, we will address those. If you have any tech issues, folks, put them there, and I will get you guys as soon as I possibly can. Just remember, there's one of me, and there are very many of you. One other area to do housekeeping today is going to be your CPE credit. This class is worth 1 hour of CPE, and the way you earn that is stay logged in for 50, that is 50 minutes of your allotted time, and answer 3 of 5 polling questions. Your credit will be, of course, processed and will be available to you within approximately 24 hours. Also, download all the course materials that Jeff has made available for you. And now, folks, without further ado, please welcome Jeff Feinstein.
Thank you, Chris. I really do appreciate the opportunity to be with everyone here. Looks like we have a large audience, I think 500 registrations, and we're intending to deliver, I think, high impact content, get you some additional accreditation, and ultimately provide insight into what we think is the most powerful tax advantage strategy available to your clients. I'll start by throwing a statistic to the group, and that is in 2022, U.S. taxpayers paid $2.7 trillion in capital gains. The 2023 number is not yet available, but the expectation is it's certainly north of $2.5 trillion. There is a program called the Opportunity Zone legislation that was enacted in 2017 that's readily available. It requires the investment of a capital gain. We'll discuss the techniques associated with that. But it is relatively easy to administer. In fact, it's self-administration, and always, at least in our experience, has been accompanied by a CPA's advice, counsel, and guidance through the execution of the program. So today, what we're going to do is we're going to illuminate that program. We think it's, again, the single greatest tax shield, I should say, ever enacted for individuals. And last week's election results portend even greater scale. And so we'll talk about the qualifications, the compliance related, the qualifying source of gains, and really focus on how this can be a significant advantage for your clients, particularly as you move towards year-end planning. And I will say, we fully expect what many have called the Super Bowl of taxes to begin a legislative process early January and through the first quarter of 2025. So this is hopefully valuable and timely information. Let me dispense with the appropriate disclaimers. I'm not providing any tax advice. Of course, I'm speaking to expert practitioners. This is my high school picture. And suffice it to say, I've got a lot of experience in real estate investing. And we, as I'll introduce to you in a moment, we are a firm exclusively dedicated to Opportunity Zone investing and leveraging the legislation. This is our table of contents. We'll walk you through a little bit more about who we are, about the program, about the tax advantages associated with the program, and then we'll conclude with an actionable Opportunity Zone fund that you could consider for your clients' review and consideration. Very quickly, Pinnacle Partners was founded with the exclusive intent to execute on, again, this incredibly compelling legislation enacted in 2017. The business was formed the same year. We leaned on legal and tax experts to begin executing, although the regulations were very vague at the time. Over the course of the next 7 years, we've aggregated close now to $300 million of capital gains, and we've been designated in the upper quartile of all opportunity zone investment funds. So the expertise lies with the knowledge and the compliance and the support of the opportunity zone legislation, but we are investing in real estate, and we'll speak about the underlying projects within an opportunity zone that we source, which we think are the highest quality real estate opportunities one can have access to. So again, I've stated we've been doing this exclusively with leading guidance and advice from Novogradac, Greenberg Trarg. We are now an SEC registered investment advisor. We audit each and every fund, and we continue to be recognized as one of the early movers and still significant leaders in this nascent industry. Got a lot of recognition along the way. But let's move into the topic at hand. Let's learn about qualified opportunity zones. Chris, let's just get that first poll out, if we could, please, to see what level of awareness our audience has.
Absolutely. My pleasure, folks. Polling question number 1 is live now and active on your screens. How familiar are you with qualified opportunity zones? Make your choices now, folks. And this poll is active for 60 seconds.
I guess I don't need to, I can continue on while the polls are being completed, but it's important for us to get a baseline of knowledge here. Again, the legislation was enacted in 2017 associated with the Tax Cuts and Jobs Act. I've already given the preamble. We think it's the most compelling tax shield ever enacted, supported by the IRS and Treasury. Did have bipartisan support, continues to have bipartisan support. And as we'll discuss a little bit later in the presentation, there is the potential, very significant potential, of extension and expansion of the program. Chris, what's the baseline here?
Alrighty,
from the
folks.
poll?
So, polling question number 1, the majority coming in a little over a third. 34% of the attendees are saying have heard of it before, but not very familiar.
Okay, very good. I will tell you once again that of the 300 million of capital gains that has been invested into our funds, in 85% of the investor scenarios, we are advising with their CPA. And we've done this type of presentation. We're grateful to be in this forum, but we've been hosts to lunch and learns fairly routinely. We've been doing a lot of evangelizing to include CFA society meetings in the markets that we invest in. So again, our objective today is to illuminate the opportunity. If 2.7 trillion in taxes were paid, about $100 billion of capital gains have been invested in the opportunity zone. I believe it's been the lack of awareness and the self-administration that makes this program so easy to contemplate and execute on. So hopefully today, again, we're once again informing a large body of practitioners. So the OZ, again, part of the Tax Cuts and Jobs Act. The macro intention of the program was to unlock unrealized gains, principally in the stock market, about $7 trillion identified at the time of unrealized gains that could be levered for tax advantage investments. And by doing so, by providing significant incentives, we're moving that capital from more passive positions in the stock market to these designated zones. And very specifically, real estate investment in these zones would create economic activity. So, and there are certain requirements when you make an investment, which I'll describe, that cause us to substantially improve the asset invested in. And that's what's been causing and creating jobs, an economic stimulant effect. And in our case, we're delivering on multifamily projects. So we're delivering much needed housing because America is underhoused. I'm sure everyone's heard about that. And affordable housing has been more recently a political topic. We are delivering principally workforce, little A affordable, and student housing solutions in opportunity zones. So again, there's 8,700 zones. This was based on, there's a bit of an arbitrage here, in my opinion. This was based on 2010 census data. So although we had 2020 census completed, the program has not been updated with 2020 census information. So we're leaning on 2010 census data, and in many cases, these zones, which were based on income and employment, were designated as kind of low income designated tracts. In some cases, these submarkets are actually burgeoning now. And I'll give you some examples of these markets, but they are in all 50 states. In 18, Puerto Rico was included. And the census tracts represent a total of 35 million Americans. Now, there's in the expansion, there could be additional tracts added to the current zones greater than 8,700. This is an image, obviously depicting the census tracts and the opportunity zones. California probably has the greatest number of zones. So does Texas and Florida, as you might imagine. But you can see they're in each and every of the 50 states. By the way, I just put this in. The IRS FAQ is actually quite informative, easy to use. We refer, generally what we do is when we talk to an interested investor, I refer them to this page and then I refer them to their CPA. And then the next step thereafter is typically the three of us having a conversation, and we're talking about the qualification of capital gains. So this is the program to date. I think it's a bit understated. This is one source. It's Novogradac. They're the leader in all federal tax credit programs. They happen to be our auditor, and they track the flow of funds. And so they're estimating about 40 billion has been invested. By the way, in Q3, they saw a substantial uptick in interest and associated investment. And I will tell you that the interest in opportunity zones are correlated with the stock market, with transaction volumes. We'll talk about the qualifying sources, but think M&A, mid-market M&A, crypto at 80,000, NVIDIA at all-time highs. These are kind of episodic scenarios where people generally are monetizing capital gains. They can be short-term or long-term capital gains. They are both eligible. And so there seems to be this strong correlation. So as a result, last quarter, a substantial step function increase in interest and allocation. We expect the same for this quarter. Again, why this is timely for year-end planning. So let's take a quick look at the benefits that are earned when investing a capital gain into a qualified opportunity zone fund. The term fund is the nomenclature applied. That can be a single asset or multi-asset fund of one or multiple real estate projects. For the purposes of the presentation today, I'm focused on our execution, which is real estate. About 95% of all opportunity zone investing is being delivered in real estate projects and opportunity zones. However, I will just call out, there is an opportunity zone business feature of this legislation. It just hasn't had the take up that real estate has for a variety of reasons. Maybe a subject for another seminar. But again, our focus has been exclusively on real estate. So when you invest a capital gain short or long term, within 180 days of the sale, that capital gain is qualified for Opportunity Zone tax benefits. The 180 days is generally, in the case of a stock sale, it's time-stamped, easy to track and measure. However, for partnership K1 gains, that 180-day clock can start at different points in time. I won't go into the specifics, but maybe again as a follow-on, we can provide you the primer on whether that is at the time of sale, say a business sale, or at the end of year, or lastly, March of the next year. So that 100-day clock can vary in the case of a partnership K1 gain. But let's use, for the purpose of conversation, straight ahead stock sale. We print that trade today. We have 179 days to seek the investment of an Opportunity Zone fund and qualify for the deferral of the tax associated with that realized capital gain. So that realized capital gain may have been short term because I held less than 12 months and I was top ticking Tesla and I generated the gain. So I'm now deferring at 39% rates, or it's a long-term gain at 23.8. You are deferring the tax associated with that gain through December 31, 2026. That is the tax year in which the deferred tax will be recorded. However, payable April 15th of 2027. Now, later in the presentation, I'll talk about the possibility of extension of this deferral period. But at the moment, we have through December 31 of 2026. The second benefit, I'm going to drop to number 3. Before going there, I will state that the benefit to the deferred tax is the following. And imagine I've had thousands of conversations with investors. Many of them see that as an interest-free loan from the government, and they'll take it. It allows them to do sufficient planning, maybe carry forward losses. Another group says, I'm establishing basis in the real estate at the pre-tax value. So simple math, $1 million capital gain from the sale of NVIDIA. First of all, you take the basis and you put it in your pocket tax-free. You can invest all or part of the $1 million gain, assuming it's $1 million gain. But let's again say, for example, they invest the $1 million into a Opportunity Zone fund. They're establishing basis in the underlying real estate with that $1 million investment, not the after-tax equivalent, which might be $728,000 after tax. So those are the two perspectives that our investors appreciate about the deferred capital gains tax. The second benefit, although number 3 on this slide, is the use of depreciation without recapture. This is quite significant. I think, again, I'm speaking to a very expert audience, but depreciation is very tax efficient, as we know. But at the time of terminal sale of the asset, we are expected to recapture. And that's yet another supposed tax on that depreciation that had accumulated. So in the case of an Opportunity Zone investment, there is 100% step up of basis at the time of sale. And there is no recapture of depreciation. So it's an incredibly tax efficient solution, different than traditional real estate. And the third, and I think the single greatest benefit of the program, is at the time of terminal sale, after holding for 10 years, there is zero capital gains associated with the appreciation in the underlying real estate. So any profits earned from the sale of the OZ investment are tax-free. And this is extraordinarily compelling, and no other alternative exists that provides tax exemption on an invested position. So these are the three benefits. Now, there's some nuances I'll share with you very quickly. Number one, you must invest a capital gain. I asserted that. Number two, we must, as a OZ fund manager, we must substantially improve the asset. So you can't invest in a cash flowing apartment. You have to double the basis, which has led to, again, creating economic activity, led us to do ground up development of land that we purchase, and we meet that test. And then they don't want anyone flipping out of investments. So they encourage the 10-year hold, which is just a couple years more than a traditional real estate holding period. And in exchange for that, they give you the tax exemption status. After 10 years, as the fund manager, we fully expect to be selling the assets and redeeming our tax exemption. We have through 2046 to disposition our assets, but for our purposes, we're expecting to sell our assets once they qualify for tax exemption. Now, what are the eligible or qualifying gains that are suitable for opportunity zone investing? So we talked about the sale of stock, and that's straight ahead. The sale of real estate, that could be your primary residence, and as you know, you get the first 500,000 deduction, but thereafter anything is considered capital gain. We've got a number of business sellers that get a significant liquidity event and wish to invoke the tax shield provided. The sale of crypto is, similar to the sale of stock. Here's an item that most people don't know: carried interest. And by the way, in 2017, the same year that the OZ legislation was enacted, the holding period for carried interest was extended to 3 years minimum. Otherwise, carried interest held less than 3 years is characterized as short-term capital gains. So we've had a number of hedge fund investors and private equity partners who have generated significant gains in carry invest in opportunity zones. And then lastly, partnership interests and trusts and other vehicles, they all conform and can invest in opportunity zones. So I think, Chris, at this point, if I'm not mistaken, we want to launch our second poll question.
Yes, indeed, folks. Polling question 2 is now live on your screens. What are the eligible gains that can be invested in QOZs? Make your choices now, folks. Active for 60. And remember, folks, if you have any questions for Jeff, by all means, put them in the Q&A. If we do have time, we will address those here today for you guys live. And we will be sending you for a report after the webinar with those questions that are unanswered.
So I'm going to move through 3 case studies. These are representative of the type of investors we engage with. And I also want to reinforce that the tax planning side of this discussion is quite significant. And it's just a great way to engage with your client to look holistically at all assets and determine where gains could or should be harvested, apply tax planning, tax advantage solutions wherever possible. In this case study number 1, we see a lot of this more recently. Of course, everyone's well aware of NVIDIA's parabolic rise. And what we have found is most people have concentrated positions, are seeking diversification, desirous of some real estate exposure, but really don't want to pay the tax. And so this has been a gateway solution for those individuals where they can sell, defer, ultimately gain tax exemption, as opposed to selling and reinvesting in yet another taxable equity position. And what this case study describes, by the way, we've seen a number of people invoke options and straddles to hedge or monetize their position, all of which can be invested in an opportunity zone, even if you don't get the stock called away. For some of our more sophisticated investors, they've done this. But the point here is that the basis goes in your pocket. That's a common refrain, and you can invest all or a portion of the capital gain into a qualified opportunity fund and begin building a real estate portfolio and meeting your diversification objectives.
Hey, Jeff.
Yes.
For poll question number 2, the attendees were coming in at the highest level at 77%, answered all of the above for that one. And if you don't mind, we can go ahead and run poll 3 now as well.
Oh, thank you, Chris.
Sure thing. Folks, polling question number 3 is now live on your screen. It is asking, is there depreciation recapture in opportunity zone investment? Make those choices in, of course, 60 seconds.
Okay, that should be a pretty rapid fire response, I hope, if I'm doing my job correctly. So Chris, I will move on unless you've got immediate results.
Go right ahead, and I'll close this poll when it's done. You can keep going.
Okay. So the second, and again, I've kind of talked or editorialized around these scenarios, but just want to call them out very specifically. So case study number 2, real estate seller. I've seen a lot of this of late. Primary residence in particular, lots of appreciation over a 20-year hold, and maybe lifestyle change, relocation, whatever the scenario is. You take the basis, you put it in your pocket, tax-free. There's $1 million of cap gains remaining. We see many times individuals take some proceeds for cash flow and lifestyle expenses, and then they invest in the opportunity zone and enjoy the again the deferral, and then ultimately the tax-free appreciation. Many times in this scenario, and in particular, I would say real estate investment property, I'm sure everyone here today is familiar with the 1031. And what we've done here is list the advantages of an OZ investment over a 1031. So 1031 has now become permanent and is frequently utilized in real estate investment sales. There are significant differences between OZ investments and 1031 exchanges. And suffice it to say, many people very much appreciate the flexibility of the OZ investment. How is it more flexible? Quickly. Number one, we go back to you take the basis and you put it in your pocket tax-free. So in a 1031, as you know, you're exchanging like kind into something similar with both basis rolling over the associated appreciation and assuming debt equivalence. And you don't do that in the OZ. You put the basis in your pocket, you invest all or part of the gain. You may have had a partner in your prior investment, and in the 1031, you're required to retain that partnership, but not in the OZ. OZ again, you'd break that partnership, and everyone would be left to consider their allocation into the OZ. And many of the 1031s in the recent portion of the cycle have been difficult to obtain. These are typically cash flowing, creditworthy tenant type, CVSs and so forth. And frankly, the cap rates just haven't been attractive. So we've seen a number of 1031s, boss is the term, and then they come towards the OZ. The last thing I'll tell you is that the 1031 requires an intermediary. There's no intermediary required for OZ investments. And then the third strategy, case study rather, is this carried interest. This has been the typical persona here is the hedge fund manager actively trading, maybe short a particular position, closes that short, generates significant gain, and is now taxed at 39 or 40% rates. This is what they call a pair trade. So they take those gains and they allocate into the OZ and get all the tax benefits and diversification that they're seeking to pursue. More recently, we've been seeing, and this is really quite interesting. And of course, we've got a large audience of practitioners, as I mentioned. But we've been seeing, dentists sell their practice, veterinarians, a lot of PE consolidation in some of these niche industries and markets, and as a result, they're getting significant liquidity from the sale, and they may be selling real estate with the business. So we've counseled with many investors and their CPAs, of course, on ways in which they can shield a large portion of that of those capital gains. And remember that in an LLC or partnership K1, that 180-day clock, may vary. And so, we see, what are some scenarios we see? We see, before estimated tax payments are due, we get a flurry of activity, people identifying qualified gains by looking back on the ledger. Some people are planning forward. You can straddle years. You can invest, as we get closer to year end, you can invest a capital gain realized in 2024, but invest in the Opportunity Zone Fund in 2025 and still defer tax for 24. And that's using the 180-day rule. So moving on, the election results portend, we think, a significant expansion and extension of the aforementioned benefits. And there's some other initiatives that will likely be built in. But prior to the election and earlier in 24, bipartisan legislation sponsored by Senator Tim Scott and Senator Cory Booker, representing the R and the D, introduced legislation to expand and extend the Opportunity Zone program. They had each seen significant and meaningful economic activity associated with the OZ investments and the projects within their states. And this went as far as the House Ways and Means Committee before the Speaker resigned in turmoil throughout the balance of the congressional calendar. We believe that, and this is we've got a blog post here where we've kind of aggregated the news flow in the last 5 days, but we have high confidence that the OZ legislation will be extended. It's likely that, as I said earlier, the Super Bowl of tax initiatives will take place after inauguration, but very quickly with what they call budget reconciliation, as they did the 2017 tax cuts. And they will not sunset because inaction would cause them to sunset. Rates would rise. They will likely almost entirely be extended, and the Opportunity Zone legislation will be part of that. So it's our high conviction that we will see the program expanded. This is the text as it was originally introduced. As you can see, timestamp. This is HR 5761. And what it means for those that have already invested and those that seek to invest still this year and certainly next year is that principally the deferral period will move another 2 years. So tax year instead of 2026 would be 28, payable on April 15th of 29. We think that's quite significant. There may be a 10% step up, meaning a discount on that deferred tax as well. That's what the program originated with, but has since expired. The other provision, this is quite interesting, is that it will allow fund of funds. Maybe some of your clients might have created their own qualified opportunity fund, and that is certainly possible. But they would then have to go execute on their own, independent of any other source of capital or expertise. They're intending to allow fund to fund. So if you had a client that took a very large gain, wrapped it in a fund, got the deferral, and had a business plan to invest and execute themselves, but have reconsidered that, they can now invest in our fund. So that's a material change. And then they're expanding the reporting requirements for us as the fund manager to report to the government the type of investments we are making. And again, we invest exclusively in multifamily projects. So we think we're going to be adhering to the spirit of the program. This was the original text that, as I mentioned, kind of got stuck in 24 with congressional proceedings, but we believe this text and more will be rejuvenated very quickly. And our partner, Novogradac, is influencing policy now and beginning to write the improved version of the OZ legislation. Now, I'm going to be concluding. Chris, do we have any final OZ-related poll questions, or are we moving on now?
We are moving right along. Go right ahead.
Excellent.
Continue. Yes.
Thank you. So we wanted to talk about an actionable, kind of call it a case study, but this is our fund that's currently in the market. We typically put one fund together over a 1 to 2 year period. What we call curate the projects. In other words, we identify the projects. We don't come to market with a blind pool. We allow our investors and their advisors to diligence our underwriting, which we think is institutional class. And you may ask, what about real estate at this point in the cycle? Well, we're quite optimistic that we're moving to a new cycle, or evident by the rate cut environment that has liquefied the markets quite a bit. And we've been at this since 2017, have 17 projects that we've capitalized, and we have moved from what we call podium style projects, which are typical 5/2, 7-story, urban located multifamily projects, to garden style, which is generally surface parking, maybe 4 stories, lower cost to build as the rates were rising and costs were increasing, to build to rent communities. And this is our current offering, and we think it's a significant emerging category. I don't know if you're familiar with BTR, or build to rent communities, but effectively the cost of ownership, home ownership, has surpassed the total cost to rent, as we know, in most cases due to high mortgage rates. And we are building either single family detached homes or townhomes, fully amenitized and proximate to services, schools, medical facilities. And this is not for sale, as most home builders would pursue, but this is for rent and a rental community. So again, this is our market update, and I won't read it, of course, but we see this as a very attractive time to be investing in real estate as we're embarking on this cutting cycle. And BTR communities are where land is more abundant. So you'll find these communities, certainly Arizona, in the Southeast, in the Smile States. And what we found based on our experience is the typical renter is generally that young family, desirous, as I said, of their own green space and maybe detached home with amenities. And they are willing to pay up to 10 or 15% premium to live in a build to rent community. So we believe that the renter profile is sufficiently attractive, if not more attractive than ever before, and the cost to build is less than the aforementioned what we call podium style development. So we have selected, and our fund represents just 3. Remember, these are projects in opportunity zones. That's the requirement. 3 very well located projects. This portfolio will deliver 500 townhomes for rent in Decatur, Georgia, just outside of Atlanta. That's a opportunity zone. Augusta, Georgia, And there's a lot of activity there, university medical facilities, and even a cyber installation, government employees. In Huntsville, Alabama, known for its aerospace and space industry base.
Hey, Jeff,
And yes.
I think we are just in time for polling question number 3,
Oh,
folks.
well, wonderful.
Yes, indeed, folks. Poll 3 is on your screens, and it is asking, what does BTR in BTR communities stand for? Make your choices now, folks, for 60 seconds.
So this is simply, again, a case study. This is an actionable opportunity any one of your clients can consider, but I'm not promoting that. What I'm using this to suggest, and we're not going to take a lot of time to get into the underlying real estate, but it's an attractive real estate projects, right? It becomes diversified by nature of the markets. There are 3 that we are participating in. And what a client would do would invest the gain as described, and then it is self-administration. So you simply, on Schedule 8879, you identify the gain, and then you pair that with the registration of the tax ID number associated with the opportunity zone. And that then accomplishes deferral, the start of the 10-year clock. And that's all that's required for your client to invest in an opportunity zone fund. This fund then will generate cash flows, provide a substantial return on capital at refinancing. Those cash flows come from net operating income, again, using depreciation throughout the holding period. We intend to deliver the about 25% of the original investment back through refinancing, tax-free. And then, of course, at terminal sale, yet again, another tax-free event. But again, the key point here is self-administration. Yes, Chris.
Yes, just going to give you a little feedback here from the attendees on that last
Yes.
poll.
Mm-hmm.
They have selected at 64% BTR means build to rent.
Excellent.
Excellent.
Okay.
All righty, folks.
It's an emerging asset class. A lot of institutions are getting behind it. You might have read about that. So this is just, again, to suggest and illuminate an actionable opportunity that your clients can consider. We'd be happy to discuss that with your clients. I think, Chris, we're coming up to the end. Did you have a final poll question?
Yes, there is polling question 5. We can run that now, and there are a lot of questions waiting for you.
Excellent.
I'm going to go ahead and run poll 5 now, folks. And the question is asking, it is on your screens now. Do you think your clients can benefit from the tax benefits associated with QOZs? And while that poll is running, Jeff, do you want to begin answering questions from the attendees? I can field some for you if you like.
Yeah, I see them here. Okay, so the first question here is, can we defer capital contributions made to QOZBs? I'm interpreting this question as like, is there a capital call system? Or remember that you have to make the investment within the 180 days. And the investment is defined by, and what we provide, the source documentation is the wire, the subscription documents. This is, by the way, a 506C offering, a Reg D offering. And it's a one-time capital call. So you invest the gain. There's no other future capital calls. It's lump sum one time. I hope I've answered the question. Next question. So the cash flow distributions are taxed at ordinary income. The answer is yes. But you can mitigate that tax with the use of depreciation. There's another question relating to the capital gains rates. They are at the prevailing rate at the time of the investment. At the time the deferred tax is due. So in this case, Current legislation would be 2026, with the significant probability of extensions we discussed through 2028. There is an attempt, I will tell you, to set the rate at the time of investment. So that is something we're pushing for, and Novogradac's pushing for. So if today you made that investment, the current capital gains rate is 23.8. That is the rate at the time that the deferred tax is required to be paid. Remember that as we generate ordinary income, we're offsetting it with depreciation, and we use accelerated depreciation cost seg analysis. I'm a one person. Can I do this alone? Yes, it's very, very easy, as I mentioned, to administer. We can help you. We've got tax guidance on staff and retained and at your service. I'm sifting through lots of questions, some more verbose than others. How much is required to invest in the Pinnacle Opportunity Zone Fund? We're generally $100,000 minimum of capital gain. Remember, it can be short, long. It can be any combination of a series of capital gains, not a singular gain. A lot of questions about minimums. There's no prescription as to what can be built. You could technically, there are sin restrictions, as they call them, but you could build a casino in an opportunity zone. So all they require is that you meet the substantial improvement test. So as I discussed earlier, you cannot buy a cash flowing apartment building. You must substantially improve and meet the test, which is a doubling of the basis. But other than that, they're not prescribing low-income housing as an example. If you look at our website, you will see, we'll put a banner that you can click off to. We've done a lot of workforce housing, a lot of affordable housing. We've done some mass timber construction. We've done student housing. So those are the products we feel are the best of all the multifamily product types, and BTR probably in the single best, as we just discussed. By the way, I do want to offer that we do this education routinely. We'll come in, we'll do a lunch and learn, we'll send sandwiches or whatever's required. Happy to be an educational resource and happy to bring Novogradac as our audit partner to any one of these meetings. Is there a limit on OZ credits? There is no limit per se. Again, tax exemption, no matter what the appreciation is. So no limits, no caps. Let me close by saying this. I want to make the point, there are not many, as an individual taxpayer, there are not many tax advantage solutions that I can pursue that aren't overly complicated. I tried to get solar on my rooftop. It was, full of machinations and complications. I have bought an EV car and enjoy the $7,500 credit at point of sale. But there are not many other advantages, tax efficient alternatives that you can execute on that are relatively simple to administer and straight ahead style of investment like real estate has been for many. So yes, 1031 exists. Maybe there's new energy tax credits to be applied somewhere somehow. This is, we think, the most compelling and will be rejuvenated very soon, we believe, with extended and expanded benefits for all. Oh, good question here regarding state taxes. Everything I've talked about is at the federal level. Novogradac has a map, easily accessible, that describes which states conform, meaning they allow the coupling of the state capital gains tax and the federal tax, and which states don't conform. And I will tell you, two largest, population areas, California and New York, do not conform. So we are talking specifically about federal taxes only. There are some states that do conform, and I will tell you that most states and local jurisdictions are actively promoting opportunity zones by accelerating permit process, seeking to attract investment in those markets. We've worked with many of those jurisdictions. They've really accommodated us. And but very good question there. I'm looking at other questions. I'm so much more confused. Dang. Okay, so there are lots of questions that seem to be situational on a particular property or client-driven need, and I would very much enjoy speaking to you about that offline. I can be reached at jeff@pinnacleoz.com, and we can discuss that. Are you able to move the fund contributions from one QOF to another QOF? Very good question. Yes, you can. There are two ways to do it. You create an inclusion event, which becomes a taxable event, or you could roll over one QOF to another. These are technical terms. And let me also tell the group, you can also sell before the 10 years, and there are implications of doing so. We have sold our very first property before the 10-year hold. Why? Because we got an outrageous offer that was greater than the taxes to be paid. And we took that to our investor base and we asked for unanimous consent. We got it. So you can sell early if extraordinarily compelling. You can move from one fund to another. We have seen some funds, for whatever reason, wish to disperse their investments. They couldn't maybe find a project to invest in, whatever the case may be. There is either a rollover scenario or an inclusion event. I can speak to that separately. Now, let me talk another very good question. Tax benefits. The imputed value of deferral of use of depreciation and tax elimination is, and this is performed by Novogradac, is an additional 400 to 600 basis points lift to the IRR of the underlying real estate. So this BTR fund, we are projecting a return to investors of 15% over the 10-year hold before tax benefits. So that could look like a 19 or 21% total tax equivalent return. That's the power and the imputed value of the tax benefits. And Chris, you can cut me off whenever you wish. I'm scrolling through lots and lots of questions. Is due to sunset. Again, yeah, somebody's writing, it was OZ legislation due to sunset. Capital gains will need to be recognized, I'm hoping. The extensions we think will very likely be enacted. It will grandfather all prior investments. So in other words, I'm invested in every deal we do. I've got some 2017 vintage investments, 17, 18 rather, and I will continue to defer through 2028. Somebody makes an investment decision today, it maybe feels like a call option, pretty good upside to be had, assuming the legislation gets enacted, and we're fairly certain it will. Chris, there's some questions about handouts, tech issues with handouts. I'll defer to you, but we have this presentation available to everyone.
Yes, indeed, folks. And for those of you who had issues with the handouts, they will be made available to you in your account following the presentation as well. Sorry for any inconvenience there. Jeff, do you have any final words of wisdom for the group before I close up?
I think once again, just where I started, 2.7 trillion in capital gains taxes paid in 2022, likely to be equal or greater than in 23. I know we just passed a big deadline there in October. This is a vehicle to be used and contemplated for anyone monetizing cap gains. I think it's a great way to have and stimulate year-end tax planning. We will be your resource for updates on the legislation. Again, I can send to this group a recent aggregation of all the news items associated with it. And I look forward to meeting you and happy to discuss client-driven scenarios with you very specifically, and happy to continue the conversation in a lunch and learn basis if you would like. Thank you for your time and attention, and we'll try to address all the other questions in somehow, some way. I'll work with Chris to do that.
Awesome. Fantastic, Jeff. Really appreciate you as well. Well, folks, we here at CPA Academy, we're going to wrap things up on our end. Your credit will be processed today and will be available to you within 24 hours. Check your inbox right now, folks. There's a full webinar evaluation there waiting for you. All course materials as well as a recording will be in your account. Thanks again to our presenter today, Jeff Feinstein, for coming in and giving a fabulous presentation, and to you for coming in as audience members and attendees seeking your CPE rather. We look forward to seeing everybody on future webinars, and please have a wonderful rest of your day. Take care,
Thank you,
folks.
everyone. Bye-bye.